Hello and welcome to The Explainer. So today we're diving into something that's a bit like, well, financial archaeology. We're not digging for old pots, but we are hunting for hidden value in the wreckage of struggling companies.
Think about it. You see a massive company, and it's teetering on the edge of collapse. Now, for most people, that just looks like chaos, right? A sinking ship. But what if that very crisis was actually a structured opportunity? What if you could buy into that company, not for full price, but for pennies on the dollar, and potentially come out with a huge return?
Well, that's the whole idea behind distressed debt investing. We're talking about buying the debt, things like bonds or loans, of companies that are in really serious financial trouble. And because the risk is so high, this debt often sells at a massive discount. You can think of it as bargain hunting for the good stuff, the valuable assets inside a company that's caught in a perfect storm.
But before you can even think about finding that treasure, you have to learn how to navigate the maze. And in the world of corporate turnarounds, that maze is the legal bankruptcy framework. Believe me, if you want to be a successful investor here, you have got to know the rules of the game.
In India, this whole process is governed by the Insolvency and Bankruptcy Code, or the IBC. What it does is provide a really structured, time-bound path to figure things out. So once a company enters what's called the corporate insolvency resolution process, a 180-day moratorium kicks in. And this is basically a race against time for everyone involved to agree on some kind of rescue plan. It's an incredibly high-pressure situation where fortunes can be made or completely lost.
Now, to really understand the risk, you have to understand the waterfall. See, when a company is getting restructured, not everyone gets their money back at the same time. There's a very strict pecking order. Right at the top, you've got your secured creditors. Think banks who have collateral. They usually get most of their money back. A little further down, you'll find other financial creditors and then operational creditors, like suppliers. And way at the bottom, the shareholders. They almost always get wiped out completely. So, where an investor's debt sits in this waterfall, that is absolutely critical.
Okay, so theory is one thing, but let's see how this actually plays out in the real world. We're going to look at a huge, really complex case that put this entire process to the test, and honestly, it shows exactly what's possible.
Let's talk about SR Steel. For decades, this company was an absolute titan of Indian industry, a massive steel producer. But, a combination of a big downturn in the steel market and some internal issues sent the company into a total financial spiral.
And that spiral? It was fueled by this just staggering number, 54,000 crores in debt. That's over $7 billion US. It was a debt so large it threatened to just swallow the company whole, and that's what pushed it right into the new bankruptcy process back in 2017. The resolution was, well, anything but simple. It kicked off this fierce bidding war between global giants like ArcelorMittal and Tata Steel, and the whole thing got bogged down by these intense, lengthy legal challenges. The delays dragged on for years, which created this enormous cloud of uncertainty for absolutely everyone involved. But here's the payoff. Right in the middle of all that chaos, some really savvy investors were buying up SR Steel's debt for as little as 20 or 30 cents on the dollar. But then, after ArcelorMittal's final bid was approved, that same debt became worth around 60 to 70 cents. It was an incredible return for those who really understood the process and were willing to take on that risk.
So, the SR Steel saga, that shows one way to succeed, but it's definitely not the only way. Investors come at this market with all sorts of different strategies, and it all kind of forms a playbook for how to handle these situations.
You can break it down into two broad camps. On one side, you've got passive investors. They buy the discounted debt and then they just wait. They're hoping for a good outcome. It's a lower cost way to do it, but it gives them zero control. On the other hand, you have active or control investors. These are often specialized hedge funds, and they buy up massive chunks of debt for one reason: to get a seat at the table and influence the outcome. It costs way more and you need serious legal and operational smarts, but it gives you a say in what happens. Okay, so we've seen the huge potential rewards, but it is so important to understand that this is one of the absolute riskiest games in all of finance. For every incredible success story you hear about, there are plenty of others that end in total loss. One of the biggest traps is something known as falling knife syndrome. Here's how it goes. An investor sees a price dropping and thinks, wow, that's cheap, so they buy in, only to watch it get even cheaper as the company's problems get worse. Trust me, trying to catch a falling knife is a painful and very common mistake. And that's not the only danger, not by a long shot. Investors often get wiped out because they just don't do enough homework, or they get way too confident about how much money they'll get back, or they completely underestimate how long and how messy the legal fights are going to be. Any one of those mistakes can erase all your potential profit. So if there's one key takeaway, it's this. Distressed debt investing is all about a core tension. It is a high-stakes hunt for value right in the middle of corporate chaos. And success here, it's not about luck. It demands this rare mix of deep financial analysis, really sharp legal knowledge, and, maybe most importantly, the emotional discipline to stay calm when everyone else is panicking.
Which brings us to a final and pretty provocative question. Are these investors just vultures picking over the bones of a dying company? Or, by providing money when no one else will and forcing a resolution, are they actually performing a vital economic function? You know, one that allows capital and assets to be recycled, maybe saves some jobs, and helps create stronger companies from the ashes of the old. It's a debate that sits at the very heart of this fascinating and very risky corner of the financial world.